Hi everyone, welcome back to the second video of provision for doubtful debts. Today what are we going to do is we are going to solve some problems on this topic, okay, provision for doubtful debts. In the previous video we have seen the entire logic and the concepts, and we have taken two different cases, right? And I have explained you each and everything in very much detail, and with that base you can easily solve any problem related with this provision for doubtful debts of final accounts, okay? So in this video, as I said, we have to solve some problems. So first we'll take up this small problem, illustration 4 from the CA Foundation study material, and then directly we'll go into the material itself in the tab, and we'll solve full-fledged problems, okay? And we'll see how this adjustment provision for doubtful debts is actually done properly in the full-fledged question. All right, so let's start. Now see here, let's read and analyze the question. It's really simple. On 1st April 2020, provision for doubtful debts existed at 40,000. So this is what? This is our old PDD. Provision is already maintained in the business. This is coming from the previous year. Is that clear? Okay, that's old provision. We can also call it as old PDD, provision for doubtful debts. Fine. Trade receivables on 31st March 2020 were 15 lakh. Okay. So that's the debtors balance, account receivable balance. Yeah. And then see here, bad debts totaled 1 lakh. What is the meaning of this? Bad debts have happened of how much? 1 lakh. Now here you have to properly assume one thing. Understand, two options can be there. Either these bad debts are from the trial balance, or these bad debts are in adjustment. We also call that as further bad debts. And if you have watched the previous video, then you properly know what is the treatment. If these bad debts are from the trial balance, then you will not subtract this from the receivables, from the debtors, because accounting treatment of that will be already done. That is why it will be appearing in trial balance. Okay, that's the first option. The second option is that if it is from the adjustment, then the accounting treatment is not done. Adjustment means it's after preparing the trial balance. So that is why you have to do the accounting treatment, complete accounting treatment. You have to deduct it from the trade receivables. It will also appear in the balance sheet, as well as the effect will go into the profit and loss, right? That's what happens if you have got further bad debts given in adjustment. So now here you have to make the assumption. Now this is such a small question, so we can safely assume that these are the bad debts given in adjustment. Why is that? Because they haven't told us anything that bad debts are given in trial balance or something. So we can safely assume that these bad debts are what? Given in adjustment. These are further bad debts. Okay, they were found out or happened after preparing the trial balance. Is that clear? So these are the bad debts given in adjustment. Is that clear? So we have to deduct this 1 lakh from 15 lakh. Okay, so 14 lakh will be the debtors. Is that clear? In the balance sheet. And then of course the provision and all, we'll see, don't worry. So let's go forward. See here, it is required to write off the bad debts. Okay, we'll do that and create a provision equal to 5% of the receivables. Show how would you compute the amount debited to profit and loss account. Now understand, what is the requirement of the question? This is the requirement. Requirement is they just want to know how much will go to profit and loss account. But we'll do the entire thing and see everything. Okay, so how will you start? How will you do? Really simple. You just have to create the ledger account of provision, T account of provision, okay, PDD account. So see here, it's really simple. You all know PDD account is a contra asset account. It acts against the trade receivables or the debtors or account receivables. So it's a contra asset account. It's a contra asset account which has credit balance. Credit balance means what? Credit balance means if you want to increase this account, you have to credit. If you want to decrease this account, you have to debit. Okay, and the opening balance will be on the credit side, and closing balance will be on the debit side. That's what credit balance for any account means, right? So let's see how this account is prepared. Understand properly. It's really simple. How much PDD existed? Yeah, the opening balance was 40,000. So by balance B by D brought down or brought forward 40,000. Okay, opening balance on the credit side, because it has credit balance, this account. And then what will you do is you will take the closing balance, right? How will you know the closing balance? Really simple. You have to calculate the new provision. So can we calculate the new provision? Yes, we can. See here, we have trade receivable of how much? 15 lakh. And then in the adjustment, the bad debts were given. These bad debts are not from the trial balance, because the question is not saying anything regarding trial balance and all. So these are the bad debts. This 1 lakh bad debts are adjustment bad debt, okay, further bad debts. So what will you do? You will take the receivable balance 15 lakh minus 1 lakh, yeah, the bad debts which have happened, further bad debts, you will subtract. you will get 14 lakh. These are the receivables or the debtors after deducting the bad debts. After deducting the bad debts. On that you have to calculate the provision. Provision percentage is 5%, isn't it? 5% of the receivables here. Create a provision equal to 5% of the receivables. So just take 5% of that, 14 lakh into 5%. Let's just do that in calculator. Into 0.05, that's 5%, right? So that's equal to 70,000. So 70,000 is the provision you need to maintain. 70,000 is the provision you need to maintain. Yeah, easily you can calculate this, right? You understood now? Receivables minus further bad debts. You got the receivables after deducting the bad debts into the provision percentage. The question will give you, you got the new provision which you have to maintain. So this is the closing balance, the provision that will appear in the balance sheet as a deduction, just presentation, okay? It will appear over there. So this 70,000 is the closing balance. So that is why, see here, you have to take that over here. Opening balance 40,000, closing balance 70,000, which you just calculated over here, right? And then of course, what you have to do, why did we create the PDD account? Two reasons. The first is recording the loss, right? Recording the anticipated loss to be exact. And the second thing is to write off the bad debts if it happens in the next year, right? So in this year, the provision, this 40,000 was created in the previous year. It came in this year, right? It will be carried forward. Always remember, provision always carried forward. It doesn't finishes. Okay, right. So this 40,000 will be used now to write off the bad debts. How much? 1 lakh. Okay, but this, 40,000 is not enough to write off the bad debts. But still, what we'll do is we will, debit into the P&L. Don't worry. See how this will happen is in the PDD account. What you will do? You will use up the PDD account, PDD balance to write off the bad debts. So what's the entry? Entry is really simple. You all know the entry. PDD account debit to bad debts. PDD account debit to bad debts, right? So PDD account will be getting debited. It is decreasing because of bad debts. How much bad debts happen in this year? 1 lakh. Okay, this is what you do. You all know this, right? So once you have these three figures, opening balance, closing balance, and this 1 lakh, then as a balancing figure, you will find this, this figure of profit and loss. How much will be debited to profit and loss? So see here, it's really simple. 1 lakh. Yeah, this side is bigger now, 1 lakh 70. So 1 lakh plus 70,000, that's equal to 1 lakh 70 minus 40,000, that will give you the P&L balance. Yeah, how much will be debited to P&L? So that's equal to 1 lakh 30. Yeah, PDD account will be credited and P&L will be debited. See how this will be happening in the journal entry. In the journal entry, profit and loss account debit to PDD. You all know whenever we increase the provision, what happens? P&L gets debited. Our profit decreases. Yeah, we are recording an anticipated loss. So here PDD account is getting credited because of P&L. So basically, why did we prepare the PDD account? Just to find this out. Okay, and there is also one shortcut for this. If you have watched the previous video, then you would know the shortcut. Really simple. New provision plus the expense, the bad debts or further bad debts, whatever you have, just add it minus the old provision. If you do this, the same answer will come. See here, 70,000 new provision, right? And then plus expense. How much expense happened over here? Further bad debts or bad debts? 1 lakh. So plus 1 lakh, yeah, plus bad debts minus old provision. Old provision 40,000, right? So minus 40,000, that's equal to 1 lakh 30,000. The same answer will come. This much amount will be debited to P&L account. Profit and loss account debit to provision for doubtful debts account. How much? 1 lakh 30, 1 lakh 30. Is that clear? So this is what. Now what will be happening in the financial statements regarding this in the final accounts? See here. In the P&L, in the profit and loss account, what will happen? On the debit side, cross posting will go, right? See here, P&L account will be getting debited because of PDD. The cross posting of this 1 lakh 30. Here P&L account is on the credit side now, so the PDD will be there on the debit side. It's cross posting, you know that. And then come to the balance sheet. In balance sheet, what will happen? Really simple and straightforward. Okay, first you will take the debtors or receivables, whatever you want to call it, right? 15 lakh. The balance was 15 lakh. And then there were further bad debts. Yeah, these were the bad debts given in adjustment. We assume that, right? These are the further bad debts. Okay, so debtors 15 lakh minus further bad debts 1 lakh, that's equal to 14 lakh. This 14 lakh are the total debtors now, the total receivables. Out of this, 70,000 is doubtful, isn't it? 70,000 is doubtful. We have a doubt on 70,000 receivables. We may or may not receive money from these receivables, right? So minus 70,000, that's equal to 13 lakh 30, the good debtors or the good receivables. Okay, this is how you have to present. The debtors minus further bad debts, then minus the provision. Now this provision will be carried forward in the next year. Don't think that this is over. No, it's not over. It will be carried forward in the next year. This is just a presentation, understand. This is just a presentation. In the next year again, let's just say for example, now this is 2020, right? In 2021, what will happen? In 2021 or 2022? Yeah, 2022. In 2022, what will happen? This 70,000 will be there. Okay, 70,000 will be there. Right, again that 70,000 will be opening balance in the PDD. Next year PDD account, opening balance will be 70,000, and then 5% of the receivable they will maintain, and if there are any bad debt, then that will be written off. And then in the next year, you know, if whatever the balancing figure comes, that will be debited to profit and loss. Is that clear? This is how you do it. Now let's move on to the full-fledged final account problems with this adjustment of provision for doubtful debts. Let's see that. Now see, here we have the illustration 3 from the study material. Let's understand how to solve this. It's really simple. Here what's happening is provision is not maintained at all. Okay, there is no provision over here, and you don't have to create the provision also. The question is not asking you to create provision for next year. So in this situation, what will you do? And in trial balance, they have given you bad debts of 17,000. Yeah, bad debts have happened of 17,000. So see, it's really simple. First, let's just talk a little bit about the bad debts accounting treatment. First, what you do is you record the bad debts. Yeah, bad debts account debit to debtors. First, recording of the bad debt happens, and then you write off the bad debts. There are two ways to write off the bad debts. First is through the provision, but here provision is not maintained, so that option is completely out of the picture. The second option is you can write off the bad debts through profit and loss. You will just debit it to profit and loss. What's the journal entry? Profit and loss account debit to bad debts, right? That's the journal entry. Now here, understand, recording is already done. Recording is already done because the bad debts are appearing in the trial balance. So what you have to do, you just have to write off the bad debts. Just write off the bad debts. Okay. Now here the requirement is what? Prepare profit and loss account of MS ABC traders for the year ended on 31st March. But here we are specifically discussing just this this topic, so only the relevant part will understand. Okay. So see here, it's really simple. The journal entry that you will pass for this to write off the bad debt is you have to write it off through profit and loss account. You just have to close the bad debts account. Yeah, that's what you do now. You close all the incomes and expenses account, and they get close to P&L account, profit and loss account. So it's an expense account. To record bad debts was debited, bad debts to debtors. Now to write off, what you will do, you have to make an equal credit of bad debts. That's how you will write it off. Okay. So see, profit and loss account debit to bad debts account 17,000, 17,000. The amount was 17,000 now. See here, it was 17,000. All right. So that's the journal entry you will pass, and then in the profit and loss account, it will come on the debit side to bad debt 17,000. No provision. Okay, not provision. Just the bad debts will come. See the solution, the actual solution of the module over here. The bad debts are there. Where are the bad debts? See, these are the bad debts. Okay, bad debts. Right. So bad debts are there. Fine. Just simply you will just take it over here to bad debts. That's all. Right. Now let's move on to the illustration 4. Now see, here we have the illustration 4, but we have already solved this in the beginning on the paper. So let's not get into this again and waste time, but just understand how to visualize the question. Okay, how the case will be. See here, in this question what happened, we had been given receivables and provision balance. Yeah, receivable existed how much? 15 lakh and provision 40,000. So that's like given in trial balance. But the bad debts we assumed, and it's safe to assume that the bad debts were further bad debts. They were from the adjustment and not from the trial balance. So it was like this, see, adjustment bad debts, and then provision maintenance is also there. Now we have to create new provision for next year. So maintain provision at 5%. So in this scenario, what you have to do, you understood, right? You have to create the PDD, opening balance, closing balance, right? And then whatever bad debts happen in this year, you have to take it over here on the debit side of PDD, because bad debts are written off through PDD. PDD will be decreasing because of bad debts. And then as a balancing figure, you will get this 1,30,000, which will go to profit and loss, right? So this is the answer of this question. The same thing they have done. See here, the same thing, by balance B by D, C by D, yeah, bad debts, right? So it's the same thing, don't worry. And there is shortcut also. Now you know the shortcut also, right? Now let's move on to the illustration 12. Now see, here we have this illustration 12. We'll just discuss the relevant part. Okay, so see, here we have been given the trial balance. The debtors are there, how much? 8,60,000. And then provision for bad debts are there, how much? 30,000. Okay, provision for bad debt, doubtful debts, it's the same thing. Okay, PDD, right? Okay, and then see, bad debts 20,000. Okay, so in this scenario, what's happening in this question, all three things are there. What? Receivables, provision and bad debts. All three things are there in the trial balance. All three things are there in the trial balance. And in adjustment, you have to, maintain 5% provision. See here, let me just show you. Provision for bad debt is to be maintained at 5% of sundry debtors. So how this question will be solved, right? Only regarding this relevant adjustment. It's really simple. Just create the PDD account. Always create just the PDD account and you will be good to go. See, provision for bad debt, which has credit balance minus plus, right? Opening balance on the credit side, that's 30,000, isn't it? In the trial balance it was 30,000 now. See here, in the trial balance it was 30,000 opening balance, right? So 30,000, you will take it over here, 30,000. And then closing balance, for closing balance you have to do little bit calculation, right? You always know that. And bad debts have happened. How much bad debts have happened? Are there any further bad debts? No. But in the trial balance there are bad debts now. The recording of this bad debt has happened, but it has not been written off. You have to write it off through PDD right now, through provision. So this 20,000 will appear, this 20,000 of bad debts will appear in the ledger account of provision for bad debts here, to bad debts account 20,000. Clear? So you have got 30,000, 20,000 over here, and then this calculation, new provision calculation is really simple. You will just take the receivables or the debtors balance after deducting all bad debts, Now from this 8,60,000, do we have to deduct that 20,000? Of course not. Why is that so? Understand. You already know this. Whatever debtors given to you in the trial balance, this is after deducting this bad debt. Which bad debt? The bad debt given in the trial balance. Yeah, because the accounting of this bad debt is already happened now. It has been recorded. What was the journal entry? Bad debts account debit to sundry debtors. Sundry debtors have already been fallen. So again, you will not deduct this 20,000. This 20,000 now you will not deduct. This 20,000 you will not deduct again. Is that clear? If bad debts were there over here, then you will deduct. Those are further bad debts. Yeah, you have to do complete accounting, recording also, and then writing it off also. But this bad debt, trial balance bad debt, only half accounting treatment. You have to just write it off. Okay, that's it. So 8,60,000 receivable balance, this I have taken from trial balance into 5% as said in the question. That's equal to 43,000. Okay, let me just pull the calculator over here only. 8,60,000 into 0.05, that's equal to 43,000. All right. So yeah, let's just write. Okay, so that's 43,000. So see, 43,000 came over here. So now debit side is bigger. 20 plus 43, that's equal to 63,000. Okay, 63,000. Now from 63 you have to deduct this 30. You will get the balancing figure, that's 33. Let's do that. See here, let me just show you. 63,000 minus how much? Minus the opening balance 30. That's equal to 33,000, right? This 33,000, the P&L. Okay. Right, so 33,000 will go into P&L, or you can follow the shortcut. What's the shortcut? You all know. You will take the new provision 43,000 plus the expense. Expense means everything, bad debts given in trial balance as well as further bad debts. Now here bad debts are only there of how much? 20,000. You can get this from the trial balance. Okay, so plus 20,000 minus old provision. Old provision means whatever provision is given in the trial balance, that is 30,000. Yeah, in the trial balance you have 30,000 now. See here, provision for bad debts 30,000. So this you will take. Okay, 30,000. So 43 plus 20 minus 30. See here, 43,000 plus 20,000 minus 30,000. That's equal to 33,000, which will be debited to profit and loss. Is that clear? Simple and straightforward. So once you have done this PDD, once you have got how much to take to P&L and how much to take to balance sheet, your job is over regarding PDD. Just go to the financial statement. See here. First let's go to the profit and loss account. In profit and loss account, what will happen? On the debit side, you will take 2 provision for doubtful debts, 33,000, right? See here, we have taken this from here. See, 33,000, right? Here also it's there, 33,000. Clear? And then in the balance sheet, what will go? This will go in the balance sheet, 43,000. Okay, this 43,000, because this is the new provision that you have to maintain for next year. So in the balance sheet, it will be presented like this. See, balance sheet now. In the balance sheet, you have over here sundry debtors 8,60,000. This we have taken from trial balance. And here you will not deduct the bad debts given in trial balance. No, because accounting of that is been done. So you will not do the accounting again of that. So sundry debtors 8,60,000 only minus PDD, the new PDD 43,000. Okay, so see here 8,60,000 minus 43,000, that's equal to 8,17,000. Is that clear? So 8,60,000 are your total receivables, total debtors, minus 43,000 is doubtful, I may or may not receive. Remaining 8,17,000 according to you assume it to be good debtors, okay, good receivables. Is that clear? That's how it works. So that's all regarding the illustration 12. Okay, in this case all three are given, and adjustment there is only maintaining 5% provision. Okay, there are no further bad debts in this case, no further bad debts. Okay, so now let's move on to the next problem. Now here we have practical question number 1, and in this question what's happening is, here in these balances given, only one relevant balance is given to us, that is sundry debtors 1,20,000. There are no bad debts or provision over here, no provision is maintained from the previous year, no. It's just that here what's happening is, in the adjustment it's little bit complicated. See, 3 relevant adjustments are there, but it's not complicated actually. In the beginning you might feel that, but let's just go one by one and let's understand. It's really simple actually. So see, sundry debtor balance is given 1,20,000, and then see some errors have happened. So we have to rectify those errors, and those errors are affecting our debtors balance. So we have to fix this debtors balance. Okay, that's the objective over here. See, the first adjustment is regarding sales return. Okay, see here, value of stock as on 31st March 2020 is 3,93,000. This includes goods returned by customers. Goods returned by customers means sales return. We sold goods to customers and they are returning it back to us. Okay, sales return. They are talking about sales return on 31st March 2020 to the value of 15,000. Okay, sales return of 15,000 they are talking about. Now see, what's the problem? For which no entry has been passed in the books. No entry has been passed in the books. So this is the error of omission. Yeah. What is the entry for sales return? Understand the entry of sales return first. Sales return entry is, see here, you just debit the sales return and then to debtor. Okay, to debtor or to customer or to receivables. This is the entry. Okay, so in this entry the amount was 15,000, right? So in this what happens? In this entry what's happening? Sales return is increasing, right? And debtor is falling. This is an asset, right? This is an asset. Debtors is falling, isn't it? And this is against the sales. Okay, so now debtors is falling, but now this entry is not passed. Error of omission. This has been omitted. It has been not recorded at all. So you can clearly understand debtors are overvalued by 15,000. Yeah, you understand the logic? You understand the logic now? Yeah, debtors supposed to be less 15,000, but it is not recorded, so debtor is more by 15,000. So what you have to do, from this 1,20,000, you have to remove 15,000 because sales returns have happened. Yeah, and this entry was not passed. This entry was not passed. So now you have to give the effect of this. You have to pass this entry. All right. So that is why in the debtors, what adjustment will you do? You will subtract 15,000 sales return. Is that clear? You understood now? Really simple and straightforward. Okay. And then see the second adjustment. Sundry debtors include 20,000 due from Robert, and sundry creditors include 10,000 due to him. What's the meaning of this? It's really simple. Understand. What's happening is, there is this person called Robert. Okay, Robert. We have to pay him 10,000. Okay, in our creditors there is 10,000 amount which is due to him. We have to pay to him. And then in our receivables, in our debtors balance, there is 20,000 amounts which is due from Robert. We have to receive from Robert. So just understand, 10,000, see here. Okay, 10,000 we have to pay and 20,000 we have to receive. So what is the common in this? The common is 10 na. Common is 10 na. So this 10 you will cancel. You will cancel this from the creditors also and from the receivables also. I mean from the debtors also. Okay, from both you will cancel. Is that clear? The common balance you will cancel. It's logical na. So that is what you will do. So see the adjustment that we have to do. As per trial balance, the debtor balance was 1,20,000. And you understood how we have to reduce the sales return balance by 15,000. 1,20,000 minus 15,000, that's equal to 1,05,000. Out of this, we also have to cancel what? We also have to cancel this 10, right? This 10 whatever is common now, have to pay, have to receive, whatever is common you have to cancel that, isn't it? If you have a friend, yeah, you have to receive from him 5 rupees and you have to pay to him 5 rupees, so then it's over, the balance is finished, there is no balance at all, isn't it? Is that clear? Simple. So that's the case over here. It's 10 and 20, so whatever is common, 10 is common, so cancel the 10. Okay, that's what. So from the receivable, from the debtors balance, you will cancel the 10, and from creditors also you will cancel, but that is not relevant for us over here. Okay, only the relevant I'm talking about, that is just cancel 10,000 from the debtors. 1,05,000 minus 10,000, that's equal to 95,000. Okay, so this 95,000 will be the correct debtors balance after rectifying these errors. After rectifying these errors, do you get it? Really simple. Okay, fine. So see, easily you understood. Sales return 15,000, which was not recorded, you recorded by decreasing the debtors balance, and then here there was a common balance between debtors and creditors, right? For this Robert, we have to pay 10,000 to Robert and receive 20,000 from Robert. So whatever is common, 10,000 is common, cancel that. So that's the accounting treatment of this. We saw how we have to do that. And then see here, make provision for doubtful debts at 5% on the balance under sundry debtors. No such provision need to be made for the deposits. Okay, leave that regarding deposits and all. Whatever provision you have to maintain for doubtful debts, let's just see that. New provision for doubtful debts, 95,000 is this balance. Why did we do all this? To get the correct debtors balance after rectifying all these errors. Once we got that, there are no bad debts and all in this question. So directly on this only, on this only you will calculate the 5%. Okay, so see here, 95,000 into 0.05, that's equal to 4750. 4,750 is the new provision that you have to maintain for the next year. Okay, is that clear? Really simple and straightforward. So now let's just create the PDD account just to see. Actually it's not required also, it's really simple because there is no bad debts or nothing is there now, no opening balance also. See, just see PDD balance, PDD account, ledger account, PDD is increasing because of this 4750. Yeah, you have to create this new provision 4750. So you have created the PDD. How do you create the PDD? Always remember, you create the PDD through profit and loss. Whenever PDD increases, profit and loss will decrease. Okay, because it's getting debited to profit and loss, right? And then the closing balance 4750. Okay, 4750. There was no, what do you say, there was no bad debts or opening balance now, so it's same only. Both of these are same only. Okay, it doesn't always have to be same. Okay, here there is nothing, that's why it's same. Fine, this will go to the balance sheet and this will be debited to profit and loss. So yeah, and the shortcut also, now shortcut of there is nothing, new provision 4750, there is no bad debts happened, no old provision, so 4750 will only go to profit and loss. Is that clear? Simple and straightforward, right? So let's just see in the financial statement, in the final accounts, how this will be done. See, this amount has to go to profit and loss, isn't it? So see in the profit and loss what's happening. In the profit and loss, see here, provision for doubtful debts 4750. Clear? Easy. And then in the balance sheet, if you want to see in the balance sheet what has happened, sundry debtors balance after rectifying all the errors 95,000. After rectifying all the errors, see here, 95,000. This one will you take, not from the trial balance. Okay, because there is a mistakes. Yeah, there were mistakes. You rectified the mistakes. You took the adjusted debtors balance. Yeah, after doing the adjustment, 95,000. So 95,000, and from that you have to subtract the provision. Always remember, you have to show the provision like this. It's a presentation. It's not like provision is over. No, it's just a presentation. Sundry debtors 95,000 minus provision 4750. Yeah, let's just do that calculator. 95,000 minus 4750, that's equal to 90,250. Is that clear? Simple and straightforward. Okay, now here also they have shown you the calculation. Yeah, sundry debtors as per trial balance 1,20,000 minus sales return not recorded, less cancellation against sundry debtor, whatever is common that you cancelled, 95,000 you got, and then on this 95,000 they took 5%, that's 4750. Clear? Simple, right? So this is how you will do it. Okay, so that's all regarding the practical question number 1. In this case, what happened? In the trial balance, we had the debtors balance over here, no provision, no bad debts, nothing. But in adjustment here, we had to maintain 5% provision for the next year, create provision for next year, 5%. And then there were errors. 2 errors were there. Common cancellation we have to do, Yeah, this is not an error actually, it's just an adjustment, okay, common cancellation. And then sales return was not recorded, okay, sales return, let me just write that, was not recorded, okay, it was not recorded, so we had to record that, okay, fine. Now let's move on to the another problem, okay, this problem. Now see here we have this illustration 10 from the CMA study material. I have taken this question because with this you will get a lot more clarity, okay. So see here, in this what's happening is, in the trial balance all three things are given. See, provision for doubtful debts 10,000, bad debts 2,000, debtors 70,000, all three things are given, right? And in the adjustment you see what is happening over here is, in the first, see, write off further 6,000 as bad debt. So in this question further bad debt is also there, and you have to maintain a provision of 5% on doubtful debt, okay, for the next year. And then see these two adjustments now, 3 and 4, these are the errors which have happened, and these errors are affecting your debtors balance. So that is why you have to, consider that, okay. These are the relevant adjustment in this case. So what is happening in this errors, let's see. Goods costing 10,000 were sent on approval basis to a customer for 12,000, okay, that's a goods sent on approval basis. But what is the error? The error is that, this transaction, goods sent on approval basis, is treated as actual sales, actual sales means what? Actual sales means debtors account, right, customers account or debtors or receivables account to sales account. This entry was passed, is this correct entry? What was the amount? 12,000. Is this correct entry? No. So because of this, what happened? Because of this, debtors increased. But is this correct? No, debtors are overvalued. So what is the rectification? Rectification is really simple. What you have to do, you have to reverse this, completely reverse this, right? Sales account to debtors. It's completely wrong now, sales account to debtors. So what you have to do is 12k, right? You have to, decrease the sales and decrease the debtors, right? So you have to subtract 12,000 from this 70,000. Is that clear? That's what you have to do. Fine. And then the next adjustment is here, 2,400 paid as rent for office was debited to landlord account, okay, and was included in debtors. You see, unnecessarily debtors is coming into the picture. So this 2,400 has been recorded into the debtors. Debtors have been increased. So what you have to do, you have to decrease the debtors by 2,400. Yeah, 2,400 paid as rent for office was debited to landlord account and was included in debtors. So you have to fix this. All right. See, it's really simple. How will you adjust? Now first see the case over here. The case is really simple. In TB, all three things are there: debtors, provision, bad debts. And then in adjustment, you have to maintain 5% provision and further bad debts are there. And there are two errors. One is goods sent on approval basis has been treated as actual sales, which is incorrect. You have to reverse that. And error 2 is, that rent thing has been recorded has been included in the debtors. So debtors is unnecessarily increased. You have to decrease that. So it's really simple. Let's just see the accounting treatment. The rectifications here. Debtors balance as per TB is 70,000, isn't it? It's 70,000. See here. Debtors balance as per trial balance is 70,000. So 70,000 less further bad debts. Further bad debts have happened now. See, further bad debts 6,000. You can deduct it over here only or in the balance sheet. It doesn't matter. Okay, minus further bad debt 6,000 minus goods sent on approval basis 12,000. That also you have to deduct. I showed you the journal entry and everything. And then whatever that has happened related to landlord, that also you have to decrease. Yeah, because that amount has been included in the debtors, right? 2,400. So you have to deduct that. So 70,000, let's see, 70,000 minus 6,000 minus 12,000 minus 2,400, that gives you 49,600. This is the debtors balance after rectifying all the errors and also considering the further bad debts. Okay, 49,600. So this directly you can take it to the balance sheet. Okay, this can directly go into the balance sheet, right? And then you have to calculate the provision, 5% provision now. So this 5% provision will be calculated on this 49,600 into 0.05, that's equal to 2,480. This is the new provision. Is that clear? So now just create the PDD account. So what will you do in the PDD account? Really simple. You all know opening balance, closing balance, right? Opening balance is 10,000. Where did I get that opening balance? From the trial balance. You all know provision for doubtful debts 10,000. Simple. Yes. So provision for doubtful debts opening balance 10,000. Closing balance 2480. How? 2480. Here we just calculated now. New provision 2480. Yeah, this is the closing balance. New provision 2480. Whatever bad debts that have happened in this year, in the current year, you can get that one from the trial balance bad debts 2,000 and another further bad debt 6,000. 2,000 and 6,000, total 8,000. Okay, either you can take it together, two bad debts 8,000, or you can show that separately also. Two bad debts 2,000, two bad debts 6,000. You will not take further bad debts over here, because for the bad debts there will be only one ledger account. Okay, two bad debts 2,000, two bad debts 6,000. Fine. So let's do the calculation, right? So always, mostly what will happen is, mostly 99% of the time this side will be bigger. Okay, this side can also be bigger. Okay, sometime P&L can also come over here. Okay, that's called reverse. Okay, right. So see here, 2,000 plus 6,000 plus 2,480, that's equal to 10,480, minus this 10,000, that's equal to 480. So 480 will be debited to profit and loss. This is the balancing figure. Clear? This will go to profit and loss account. Okay, and then there is shortcut also. You can also follow the shortcut if you want, right? Let me just show you. See, new provision plus bad debts plus further bad debts. Yeah, these are the expenses that have happened in the current year. Okay, sorry, right. So plus expenses minus old provision 10,000, 2,480 plus 2,000 plus 6,000 minus 10,000, that's equal to 480. The same answer will come, you know that. So now 480 will go in the profit and loss. See here. Now here they have followed a little bit different format. Don't worry. Okay, format doesn't matter that much. Okay, see here, profit and loss account, bad debts, they have taken bad debt, additional bad debt. So ultimately what's happening, 480. That's all. You can just take here, what do you say, 2 provision for doubtful debts 480. That's all. You don't need to do all this, because you have already done that calculation and everything. If you are preparing the ledger account, or if you're doing the shortcut, then that calculation, similar sort of calculation in a different way, of course, is done over here. Okay, whichever way you follow. So you can directly take over here 2 provision for doubtful debts 480. The same thing will come. The same thing, 480. Is that clear? Simple and straightforward. Now in the balance sheet, what will happen? In the balance sheet, if you see what have they done over there? Here only they have done all the rectification, everything. See, sundry debtor 70,000 from the trial balance, minus that goods on approval, yeah, minus 12,000, less bad debts, yeah, further bad debts. These are the further bad debts, less related landlord 2,400, and then provision for doubtful debts. But the better presentation is what? You know, the better presentation is like this. See, what will you do is, you will just take this 49,600. Let me just show you what will you do in the balance sheet. See, debtors 49,600, okay, less PDD, okay, provision for doubtful debts. How much is that? PDD is 2,480, right? So 2,480, let's do that in calculator. 49,600, it's 49,600 now, yeah, 2,480, that's equal to 47,120. In the outer column you will take like this, 47,120. Okay, this will be the balance sheet presentation. Okay, asset side. Is that clear? This is what you will do. Is that clear? Simple. See, 47,120. Yeah, see here, 47,120. Is that clear? Same thing will come, don't worry, right? So I hope you have understood. We have discussed, you know, almost everything right now. Yeah, all the cases here, all 3 things are there. Further bad debts are also there, provision as well as some errors, right? So I think you have completely got this. It's really simple and straightforward. Yeah, I will see if I can upload this in the Telegram group. Okay, that will be easier for you guys. Yeah, you cannot take screenshots right now, it's really difficult, right? So that's it. Okay, I hope you have understood this. We have solved 5 problems in this video. So yeah, that's it for this video. See you in the next video. Bye.